Our next guest has the street's second highest year-end S&P 500 price target at 5,900. He raised his forecast from 5,200 at the start of the year. Here to tell us why he thinks stocks can keep pushing higher is Oppenheimer Asset Management Chief Investment Strategist John Stoltzfus. John, thank you for being here. So I guess, does Powell's speech today make you even more bullish, or do you think some cracks in the employment picture could ultimately create a risk to your thesis here? I mean, I guess it's, what, 5% upside from current levels?
You know, where we are right now, Leslie, I've got to say we thought there was no surprises in what the Fed chair said today. We've been a fan of the Feds this cycle. I've been in this business since 1983, so I came in when Paul Volcker was in his second term. So I've been a student of the Fed for years, and since Bernanke, it's never been as comfortable working with the Fed because they telegraph their punches. They tell you what they're going to do. Generally, the market still doesn't believe them, and they play against it. But this has been a remarkable cycle in the sense that they've been extremely sensitive throughout it. We've had 11 hikes and 9 pauses. That's 20 FOMC meetings and no recession. I think they're also aided and abetted by the fact that the economy is bigger than ever. There's more cash floating around everywhere, and it's global. The U.S. stands out in terms of its growth potential because of technology and innovation. So I feel comfortable. Cyclical still overweighted versus defensive. We think at this point you can look to, we've been seeing a broader rally since October of last year, October 27th. It was broad across the sectors, led by tech. Then it narrowed at the beginning of the year. We've had several times when it widens. And the smalls and the mids look like they've really got a potential here. Once the Fed begins to cut and the market gets it's one thing to intimate it's going to cut, but when it actually takes the cuts, and as long as we don't find that the Fed is cutting because we're in a recession or because they think we're about to fall into one, that's a good sign. It means in Spanish you'd say ya basta, which means enough is enough.
John, thanks for being here. Would you think that growth, those other rotations, I guess, into the Russell 2000, for example, cyclicals, for example, is that taking away directly from the Magnificent Seven from tech, or do you think they both all of them can work? I
think they can all work with tech essentially sharing the spotlight quite often. It won't be center stage all the time. Sometimes it'll move over on Broadway, right? It'll move left of stage, center, or right of it. But we can't help but think that the innovation related, not just AI, but the way it affects software, the upgrade cycle in hardware that we're about to experience, already beginning to experience. This is something that is a watershed type of event. There will be disappointments along the way. There'll be quarterly disappointments for some companies, but others, just like with retail today. Look at retail. Retail had some really good news, and the retail numbers were better last week when they came out. Or was it this week? This has been a long week, as I recall. and you've got, so I'm pretty excited about it. I think related to the Russell, my problem with the Russell 2000, I prefer the S&P 600, which is a better quality. I think you have to be profitable a year to get in there. I think that's it. And on the other hand, 40%, right? Joe Terranova always reminds us that 40% of the Russell 2000 is not profitable. Some of that probably just because they're waiting to grow, and they're waiting for business. But the Russell 2000 tends to when the tide comes in and all ships float, that's when the Russell's really leading, But the S&P 600 did pretty good today. At one point, it was just a little bit under the Russell in terms of performance.
And obviously, Russell leading the way today on the heels of those comments. John Stoltzfus, thank you very much.